Hi, and welcome to this week's look at the major stories that are affecting the markets so far. And to be quite honest, there's only one place we can really start, and that is the potential US default and what direction might the markets take. Well, obviously an economy which survives on debt means at some point the borrowing needs to be repaid. In the US, as you've probably heard, they have a debt ceiling in place, which is an actual law, which means the amount the US government can borrow is limited to $31 trillion. Now, they can have a vote on that and change that, which is something they're trying to do at the moment. And during discussions about raising this ceiling within Congress this week, many have actually said that the US could run out of money as soon as the 1st of June. It's a pretty big statement to make, but what might actually happen? What might well be affected? Well, first you've got to look at US big tech stocks. They've been surprisingly volatile over the last couple of years anyway. I was having a bit of a boom due to COVID and our habits and our online habits changing. But then 2021 and 2022 saw quite a significant decrease in their value. There's also very high operating costs in Silicon Valley where a lot of these firms are based. So if there is a default, rising costs, etc., could large, boardless multinationals move somewhere else, be that Mexico, be it somewhere in Eastern Europe, for example, which may be more attractive. Now, nobody's panicking just yet, but it's certainly something to consider. Well, secondly, obviously, we've got the US dollar. A default could massively challenge its status as a de facto currency around the world. Now, obviously, there are already moves from sort of China, Russia, and some other countries to change this dominance of the US dollar. And this credit default may well prove a nail in the coffin. And in fact, we look at it, sterling, the Great British Pound, has been very strong against the US dollar recently, despite probably greater economic concerns overall in the UK in terms of inflation, etc. So it does appear that a potential default is weighing heavy on the US dollar. Thirdly, credit default swaps. Well, what might happen there? Well, there certainly seems to be a little bit more interest in these than normal. This is where obviously people buy, or traders buy, debt from one institution and take it on board. Not for the faint-hearted for sure, and obviously had a lot to do with issues back in 2008. But it seems to be that, while it's not necessarily available to retail traders, big institutional traders seem to be turning their eyes and perhaps betting on a default more than we expected them to. And fourth, well, what about what happens across the board, if you like, around the globe? Well, if you look at the FTSE 100, which is obviously a lot of people say a traditional old-fashioned index full of blue chip stocks, firms that don't take a lot of risks, tend to have a reliable form of income. That sort of more traditional old-fashioned, if you like, index may become more attractive compared to something like the Nasdaq, which is full of sort of SPACs and startups and, not as well established, shall we say, as some UK firms. So the question really remains is it going to be a default, or is there in fact going to be more debt taken on by the US economy? Whatever happens, it's bound to cause a few waves in the market, so don't forget your risk management techniques. Okay, so we've discussed what might happen to certain markets in the event of a default. But secondly, what we're going to have a look at is the top 3 assets in case a default does happen. What are people or investors going to look for in terms of safe haven assets? Well, let's not forget, Janet Yellen has said that basically she has no plan for the fact that debt ceiling will not be raised. So clearly, US Treasury Secretary banking, if you like, to use a term, on the fact that this ceiling will be raised. Congress will vote to increase the level of debt the US can take. Earlier this week, Bloomberg polled more than 600 finance professionals between, I think it was the 8th and 12th of May, to get their views, their opinions on what the best safe haven asset would be in the event of the US default. And it's actually quite interesting. Number one, the top one, of course, gold. No massive surprise there. In fact, more than half of the respondents said they would buy gold if the government failed to meet its obligations. Yeah, we pretty much expect that. Gold's been seen as a safe haven for many, many years. Secondly, was US bonds. Now that may seem a little paradoxical to buy bonds from a defaulting government, but there is logic there, and that is that bond payments take precedence in times of default in these sort of issues. They are almost always usually paid, albeit slightly late. So that does provide some logic and some reasoning for why US government bonds would actually become slightly more popular. Thirdly, well, typically, historically, we might have expected the Japanese yen or the Swiss franc, but it was in fact Bitcoin that came in third in this poll. Now, worth remembering, cryptocurrencies are only available to professional clients in some jurisdictions such as the UK and Australia. But the Bitcoin price has been up approximately 65% since the start of this year. And if we take a look at a daily chart from yesterday, it shows the price is actually currently in a downwards trend since mid-April. That's in the red, but that's within a larger upward trend in blue. We've seen it rebound from point 1, that's a psychological level of sort of $26,000 a Bitcoin, and the lower line of the red channel labelled 2 here. And we are going to see, and we have been seeing some resistance from the red median line, that's number 3. It's still a little bit up in the air, and in fact, I think if the bears push the price further down past, say, $25,000 and below, quite possibly would reduce its attraction as a defensive asset. But it's certainly a sign of the times that these financial professionals, if you like, beginning to regard something as volatile as Bitcoin as a potential safe haven in the event of a default. Clearly, interesting times lie ahead. Okay, so we've had a bit of doom and gloom, and the fact that the US economy, the biggest, largest in the world, potentially the main driver, could well default on its credit loans. But time for a little bit of positive news, and that's the E-mini Nasdaq 100 futures hit a year's high. Now, last Friday during the trading day, they actually hit that high. That was the high for over 12 months. But they did close lower as a report on consumer sentiment came out, saying that actually consumer sentiments hit a 6-month low. And of course, all of these warnings of the credit default. So this is all going on, and yet E-mini Nasdaq futures hitting a year's high. But why? Why have they done that? Well, the Nasdaq 100 index does not include shares of large banks that are clearly under pressure due to the banking crisis we're seeing over the States. And that's one of the main reasons why the NAS E-mini futures are in fact performing significantly better than the S&P E-mini futures. We're coming to the end of reporting season, but Q1 results across the board pretty much did not disappoint investors. So a bit of positivity creeping in there. Good results, obviously good for listed companies. If you have a look at a daily chart from earlier in the week, we can actually see the price is at the upper border of the channel, which may prevent that price pushing up further, particularly with the current default threat in the back of everybody's mind. And in fact, if we have that default, it could cause a correction. And we think that, futures prices may well find support from the median line, channel line, which is 1 in the chart, which is near that psychological level of 13,000. That's 0.2. But a default, obviously, it's going to be pretty difficult to spin that in positive news for the market. So could we see a loss of this little bit of buoyancy from those E-mini Nasdaq futures? Only time's going to tell. Of course, if agreements are reached, could provide a bit of a fillip, and we could see it push slightly higher. Again, I don't want to sound like a broken record, but only time's going to tell. A lot's going to depend on what happens this week and into early next week. Okay, finally, we're going to switch our attention to a commodity, and we're going to talk about oil again. Is crude oil running on empty? As we've spoken about before, there's been plenty of price movement over the last 18 months or so. We had the global lockdowns, which caused supply chain and logistical difficulties for quite some time, pushing the price of oil up. While several economies were shut down, there were some, of course, that continued, so there was still sort of demand there for oil, but the issues pushed that price up quite severely. And after the lockdowns ended and we thought everything was going to return to normal, those supply chain issues continued sort of inflating that price. As things sort of settled down, although the price had remained relatively high, in early 2022, many countries got together to enforce sanctions on Russia. This obviously helped push the price up as Russia is a major producer of oil and a member of OPEC+. Settlement was forced to be because these companies had no access to foreign exchange accounts. Settlement was forced to be in rubles. People turned away looking for other supply. So that helped inflate the price somewhat. Now crude is much, much lower. And in fact, on May the 2nd, we saw the lowest price for over a year. And in May the 12th, we saw the second lowest price in over a year. In fact, we're looking at crude oil at times been down sort of 29% in that year, 12-month period. Crude is slightly different to other commodities. It's used in engineering, and thus the price of oil is more influenced by supply and demand than, say, something like gold, which is viewed more as a store of value, and we talk about it as a safe haven asset. We don't do that with oil. Supply and demand are clearly there, so we know demand is returning compared to levels from just a few months, a couple of years ago, but that price has fallen quite dramatically. So the OPEC nations have decided to try and reduce production to push that price up a little bit further. In April, we saw Nigerian production of oil, for example, being less than 1 million barrels per day. Saudi Arabia, Iraq and a few others have agreed and have stated they are reducing production by 1 million barrels per day. And Russia has said it's going to continue its policy of reducing production by 500,000 barrels per day. Now, obviously, the US is not particularly happy about that, but as OPEC countries supply more than 30% of the world's oil, they feel they can control the price. In October 2022, which was the last time we saw these sort of cuts in production, the price did increase by 5%. So it's an interesting dynamic. You know, in terms of energy crisis, cost of living crisis in many countries, falling oil prices, great. That's what we want to see. We need lower oil prices, we need lower energy prices. But for something that does have this sort of level of control over its supply, this reduced output could well have the desired effect for those OPEC countries of pushing that price up higher. As I say, previous cuts in output push the price up 5%. What are we going to see this time round? Well, we wish you luck with your trading in the week ahead. Bye for now.